if you're trying to accomplish big things in the world, like minimize the wealth gap or help more people get reach financial freedom. So the abundance mindset allows me to kind of make sure that goal is always in the back of my mind when it's time to, when someone calls me or shoots me emails like, okay, here's another chance to serve an individual and help them reach their goals as well.
If you're watching this on YouTube, make sure you smash that like button and click subscribe. For those of you listening on a podcast platform, be sure to subscribe on whatever platform that is and leave us a rating if you can. The more likes, ratings, and subscriptions that we get, the more we can spread the message and grow our community. So we also have a free Facebook group. It's called The Average Joe Finances Network. Check us out, join the group, join the community, ask questions, and become a part of the team. All of our other social media accounts are listed in our flow page, and we have them in the video or podcast description below. All right. Hey, how's it going, everybody? So today we have with us Larry Pendleton, and we're going to talk a little bit about what he does. Okay. So Larry is the co-founder and senior partner of PC Financial Services, LLC. He has been a CPA for more than 10 years with experience in tax consulting and preparation, accounting, and financial statement auditing. He has over 5 years of real estate experience as a multifamily investor involved in syndications, joint ventures, tax strategy, and investor relations. Larry also holds key finance and accounting positions for several real estate investment firms and adds value by implementing the same tax strategies that he recommends to his clients. So Larry, absolutely awesome having you on the show with us today. Thanks for joining us.
Appreciate it, Mike. Great for the opportunity. Thank you.
All right, right on. So I'm going to start this off the same way with the same question I ask everybody, and that is, can you share with our audience a little bit about yourself and tell us your story?
Yes, thank you. So Larry Pendleton, CPA out of Norfolk, Virginia. So Virginia Beach, Hampton Roads, for those familiar with the southeastern part of Virginia. Like I said, I've been a CPA for over 8 years, doing tax strategy, tax accounting, tax services for over a decade, and over 5 years of real estate experience as well. Decided to merge the two worlds together and apply it to myself roughly about, as of this recording, 2-3 years ago now. How I got started in accounting. Well, initially I was like growing up, like being raised by my dad, a single parent, and just kind of always noticing no matter how hard he worked and always the amount of taxes taken out of his paychecks, and then him stressing over tax season. So I was always kind of curious of how cash flow and taxes, all that worked. I just never really knew about accounting growing up. It just wasn't anything that brought in the household that much. It was just, you just kind of knew taxes was the thing that you had to deal with. But what really brought it all together was really a high school crush on a teacher of mine. We had an accounting class, and from there, like boom, I had a reason to sit in there and actually pay attention to accounting. Didn't really work out with the teacher, but I got the message and the knowledge out of it. So I guess if most of your listeners follow like Robert Kiyosaki, I kind of went to school, got my degrees, got a good job, and kind of just worked up the chain. And I mean, I think overall, like I said, I feel like career-wise and societal standards, I've done well, but it was always felt empty for me. But I always had like kind of been doing my own kind of business on the side. But like as I grew older and kind of felt a better understanding about myself, is I enjoy helping people. And what people tend to have more of a struggle with in life is with their taxes. And it's okay, I may not like love taxes, but I love the benefits that they can provide if the strategies in place that if done correctly and following what the tax code is written. And now I kind of apply that concept of just serving people, being more of focusing on that standpoint, and then how did that and mixing that with real estate can help people minimize their tax liabilities from there.
Awesome. So, I'm sitting here jotting down notes as you're giving your intro and everything. And, one of the things I really like is you're talking about how you enjoy helping people, right? And you even said it too. And as a CPA, right, you even said that you don't like taxes, but you like how you can use it, right? Like use tax laws and everything to help people better their situation, right? Whether, it's in real estate or any other thing, right? So I really like talking to people that have that service mindset, that they want to help others and help serve others. That type of selflessness in any career field is awesome. But when it comes to somebody who's trying to invest and better themselves, one of the things I really enjoy about this community, both with the personal finance and real estate investing, is just how open most people that I've met are to helping others and helping educate others. And that's what this is all about. So I really appreciate your take on that and where your stance is with that. So thank you for that.
Abundance mindset. I mean,
yeah, absolutely.
There's no reason for me to kind of not share the information that I know or help those that may need help or just need a point in a certain direction, because it does me no justice of like not bringing in more people into my circle that I can help. That just kind of expands more than I can do, especially if we're trying to accomplish big things in the world, like minimize the wealth gap or help more people reach financial freedom. So that abundance mindset allows me to kind of make sure that goal is always in the back of my mind when it's time when someone calls me or shoots me emails like, okay, here's another chance to serve an individual and help them reach their goals as well.
Absolutely. I love it. Abundance mindset. That's fantastic. So with everything that you've done with your career as a CPA, I know 5 years ago you got started in real estate. So what made you decide to get involved in real estate?
What's funny is that I always have referred real estate to my clients, and because hands down, when it comes to just tax strategies, it's really tough to beat it from that standpoint. So it was always something that I always referred to my clients, like over my decade of doing tax services. It's just I guess it was a limited mindset for myself of how to do it. And it really took my partner in the tax business, Terry O'Connor, to actually put a property in my hands. Like he had too much on his plate. He's been investing for years before I got involved. And this is like just run the numbers. You can do an FHA loan and all of that. So once I actually like got over my fear of it and saw that I still have that same property today, cash flowing $300 a month, and like I said, it's kind of just use that now as just kind of a staple of, okay, here's what this can possibly do for me, and now I can say that what I'm recommending to people is actually what I am doing instead of just in theory at this point.
Right on. Yeah. So you're not only talking about it, but you're taking action on it yourself. So I really like that. So I just know just from your background that first property, that was a single family rental, right? And I know that somewhere in there you switched and you went to multifamily. So what caused that switch to happen?
Just being able to scale, and like I knew I did not want to be in the corporate world for a long period of time. And it's funny because my wife a couple of weeks ago asked, just kind of recalled a conversation that we had when I first started. It was like, okay, I'm just gonna do a property a year, just kind of slow play it. But I think that was all still part of that limiting mindset. And then, as with most people, I'm just kind of searching on YouTube and just kind of looking on Bigger Pockets and other places, just educating myself, and came across Michael Blanc and how he went from single family to multifamily, and it was like oh, I can actually own that building that I drive past every day. So once I started kind of and seeing how, of course, I'll see how the taxes aspect of the work and just multiple streams of income under one roof, and this makes all the sense in the world. So roughly about late 2008 is really when I started kind of looking more into multifamily.
2008.
I'm sorry, 2018. I'm sorry.
Okay, I was about to say 2008. That's definitely a tough time to start looking at that. But and a little more than 5 years ago. What are you hiding from me? No, I'm kidding. Okay, cool. Yeah, so 2018. That's when you did that. That's fantastic. And one of the things that you mentioned that I think is key is the word scalable. Right? It was the scalability. You were able to scale more by going into multifamily, and that's something I hear quite often when I talk to people that made that switch from single family into multifamily. And I'm actually working on that transition myself right now, so that's really awesome. I like to hear people sharing the same thing and saying the same story, that it's not just this worked out for one person because they were lucky or whatever, right? There's a right way to do it, so that's definitely good to know. Now, you're a CPA, so one of the things I definitely want to talk about with having you on this episode today is tax benefits, right? So I'd like to talk about some of the tax benefits of investing in real estate. So what are some of the best practices for someone to build a tax plan into their real estate investments?
Well, it all starts with, okay, are you going to be flipping properties, or are you going to be holding property, actually buying a whole property, rental property from that standpoint there? So each particular route has its own strategy, but either route, you have to remember that the income from real estate is tax advantage, which means you're never taxed on the gross amount, you're taxed on the net. So you could have made whatever $100,000, whether it's a flip or a rental property, and then it's going to be net against all the expenses and deductions that you're required, that you're allowed to take, basically because you're running a business. So, but as a flipper, wholesaler, someone that's kind of more actively like exchanging property, more of a trade aspect of it. Okay, you can, once again, your income is tax advantage. You can take all these write-offs. You can also put your company into a LLC, or you should be putting your company to LLC and be taxed as an S corp, so that you're minimizing self-employment tax from that standpoint. There, I typically lean most of my clients to having rental properties, whether it's a lot or however much they want to have. I typically lead them at the direction, because I feel like that's a bigger golden ticket along the way there. Primarily because, once again, you can make a huge gross amount. You have the net, and now you're not taxed on that gross amount. And then you have paper losses, or just like depreciation. People kind of hear stuff about that. Which is a great deduction to kind of claim, because you're recovering the cost of the building from that standpoint. So like those are kind of some of the benefits of it there, just being able to make a certain amount of income, not be taxed on that income, because you're also running a business and you got the expenses as well. And then rental real estate, the reason why I lean a lot more clients, not just for the depreciation, also because you have it's considered per se passive, which means your rental income isn't subject to self-employment tax. So you don't have to worry about doing the LLC with an S corp election and paying yourself a salary from that standpoint, because you're not going to get hit with additional, as of this recording, 15.3% of self-employment taxes there. So that's why I typically kind of lean people in that direction, and then seeing how far we can get them to zero, if not a tax loss, and see how that can offset their active income there.
Yeah, that's fantastic. So I've heard this a bunch of times before, with setting up an LLC and setting up an S corp. Now, I've set up an LLC for my rental properties back in Virginia, and that worked out pretty good. But I want to talk a little bit about setting up an S corp, right? So just for our listeners out there, because I've heard this a couple times already, and just investigating it myself, but having an S corp, is it true that you can pay your family members up to a certain amount of money and have that as a write-off, or I guess a tax-free income for that family member?
And so, I guess what you're referring to is paying your children excuse me, that you're able to claim up to, as it's recording, $12,000 or 12,200 to be exact. But yeah, so you basically treat them similar to, and that's not even as an S corp. Like you can just be an LLC and then like pay your children up to a reasonable amount, up to that 12,000, but within reason of the services that they're providing, and because it's below or at the standard deduction, they're not having to pay or have withholding taxes being taken out, and then that's an additional write-off for you. So you're basically transferring the income from your higher tax bracket down to your children's tax bracket as well. And there's other strategies, and even if you are just kind of paying like other family members, you're still paying them a salary and having them wrapped into the business as well.
Okay, so for children, if you're paying your children, is there an age limit? Do they have to be a certain age where you're allowed to pay them for employment?
Yes, I get. Typically, people are calling me like they just had a newborn and they're trying to pay the baby a salary, and I never like a direct no off the gate with my answers. It's always based on facts and circumstances. Because the best example you can kind of go with is the Goober baby, and people assume that this baby was paid all this money because his face is everywhere, but that initial contract was only like $5,000-$6,000 a year. So like that's like, so you really go to that, like that's your base right there. If you're going to say you're going to use your newborn for advertising and whatever, and crawling around your living room for pictures, and that's great and all, but you're not going to reasonably say that's a $12,000 salary from that standpoint. There, like you have to kind of do some research, see what's reasonable, kind of check like salaries.com or whatever other labor bureau websites to get an understanding of what those reasonable salaries are.
Right. Yeah. I just want to be mindful of like, child labor laws and everything. Like what if I took my kids to a renovation property and had them help me like demo it and stuff, and they're knocking down walls? I mean, can I pay them for that, or is that like child labor?
There's a fine line with that, and I tell people like at the end of the day, like I believe you. Like if you say your 3-year-old was swinging a sledgehammer, okay, like I may be at caution, because like yes, like my initial responsibility is to put you in the best tax position possible, but I can only do that if I can protect you on the back end with reasonable, logical explanations and documentation from that standpoint there. So, like I say, it's I mean, and part of demo itself is also cleaning up. So it's not like they have to be knocking down walls. They could have been sweeping stuff up. How much time do they spend doing it, and kind of accounting for it from there. So it's like I said, it's never just a hard no. It's just, let's have the discussion, let's talk it out. And if it doesn't make sense to both people on the call, then like we probably should not be going down this route. Because cause my name is going to tax return just like the individual that I'm talking with. So it's like, if I'm not comfortable, I'm gonna go ahead and step back a bit, because you're doing things that I'm not fully comfortable with.
Yeah. Okay. No, I like that. I don't want to go too far down this rabbit hole. It was just that was something I was personally curious about, because I've heard this a couple times where like, oh yeah, I got an S corp and I pay my children $12,000 a year, and I'm like, what about child labor laws? I'm just trying to be mindful of that. So yeah, you might be getting some tax advantages, but you might be violating something else.
Yeah.
So, all right, cool. Going more into tax advantages of real estate. So I know one of the things that I enjoyed the most so far with my rental properties is depreciation. So can you explain depreciation and how it's a beneficial tax advantage for someone to invest in real estate?
Right. So the best way I've been able to explain depreciation is that, let's just say you buy a building for $100,000. Now you just can't write off that whole building, because it's not an expense; it's an income producing asset. So some accounting 101 geek talk there. So it basically goes on your balance sheet as $100,000 because it generates income for you. But the fact that you are providing rental housing for the masses. Like, so the government is enticing investors to buy more rental properties and from whatnot by saying, okay, if you do this, we'll let you recover the cost of the building over a certain amount of time, 27 and a half years for residential rental properties. And so you're able to say, okay, you made $100,000, but I'm able to recoup like a percentage of that amount over 27 and a half years, depending on what time of year that you bought it, and so forth there. So that's the best way. So now you have something that wasn't an expense now being treated as an expense on a year-to-year basis. So now you have, like I said, now you have a additional loss that you have that you basically did not pay out of pocket, because most likely you're not paying $100,000 cash for that percent down, and now you turn around and be able to write off basically almost your basis.
I think we've got the gist of it. How it's it's just another way to reduce your income, and with something that's not an actual expense right now, right? It's just you're able to take a certain percentage and take that out of what your income is for the year. So that's definitely a great benefit. I know it helped me this year. If I wasn't able to claim any depreciation on, I would have been owing a lot of money this year. So I appreciate that for sure. So this is kind of like I guess more of like a personal one for me, because I want to know, like, what are some of the tax benefits that you believe people often overlook when it comes to real estate? Let's take a brief moment to hear from our show sponsors. What's going on, everybody? So today I want to talk to you about Wealth Tender. If you are a finance content creator, whether that's a blog, a podcast, you're a financial advisor, or a financial coach, I highly recommend you check out Wealth Tender. Wealth Tender is building a database of all the top finance blogs, podcasts, and the financial advisors and financial coaches that they have on there are vetted and top-notch. So we actually had the pleasure of hosting Brian Thorpe, the CEO and founder of Wealth Tender, on Average Joe Finance's podcast, episode 25. Go check out that episode, listen to his story, and listen to him talk about the database that he's building. It's really phenomenal stuff. So if you're interested in checking out the directory, or if you're a finance content creator and you're interested in joining up with the directory, go to the link below in the show notes, or check out www.averagejoefinances.com/wealthtender. What's going on, everybody? So I am happy to announce that we now have our video and audio editing services live. So whether you're starting a brand new YouTube channel or a podcast, or you're already established, we have services that'll fit your needs. Go check it out, www.averagejoefinances.com/services, and you can see all the services that we have to offer, including our newest audio and video editing. Let's get back to today's episode.
Well, I think people typically often overlook one aspect of is there's depreciation, but then like there's opportunities to boost that depreciation even stronger, either through accelerated depreciation or bonus depreciation from that standpoint. So typically you can get that done by getting a cost segregation done, and that basically, from that standpoint, the best way to explain it is that building is $100,000 minus the land value of the building. So, but that building is not just is not all of that is 27 and a half year property. Like there are personal property items there that depreciate in 5 years, that depreciate in 7 years, that depreciate in 15 years, which means you can depreciate those items quicker than the 27 and a half year components of the building. So a lot of people they look over the fact of the cost of a cost segregation report, but not understanding like the back end benefits that provides, because now you'll be able to accelerate the depreciation quicker with these 5, 7, 15-year properties, and with the 27 and a half year Tax Cuts and Jobs Act, anything depreciating less than 20 years, like now you're able to claim, like depreciate all of that in year one, creating huge tax savings for those. Just saying, you could really, out of every building, roughly 10 to 30% of it is personal property items. So now you're taking that full amount, so up to possibly $30,000 of a $100,000 building can be written off in year one, possibly. So I think people miss that out. I think they kind of look at the initial cost because it's costly to get a cost segregation done. But if I'm telling you that if it's whatever this amount, let's just say $1,000 to get the report done, the analysis done, but you can potentially get $10,000 written off your tax return. Like you're stepping over dollars to pick up pennies if you're not taking advantage.
Yeah, definitely advantageous to do that for sure.
Right. I'm saying like 10 times the savings are 10 times as much on your tax return than that $1,000 fee, which you're able to write off anyway in the following year in your tax return because it's a business expense. So it's not like you're coming out of pocket and it's not coming back. Like the thing with like one of the biggest benefits of just running real estate and businesses in general is that anything that you're paying out of pocket for the business is coming back to you one way or another through your tax return. So that's one component of it that I see people miss out on a lot. I also see a lot of times people are missing out on being able to expense certain repairs and maintenance items in the year that they occurred. And what I mean by that is, so you got that same $100,000 building. You may have a $30,000 rehab budget. Now, within that $30,000 rehab budget, depending on how it's broken out, you don't have to. If you just put that on your tax return that you spent $30,000, like you cannot expense that. It's very hard to just justify that because certain components of it is going to be 27.5 years. But if you're working with your contractor to actually itemize those items to, okay, what are you actually doing line by line and invoicing certain things, so you're taking advantage of the de minimis safe harbor part of the or one of the many tangible property safe harbors will allow you to expense certain items in year one because it's under a certain dollar threshold. It's not considered material to the building component itself. And other factors as well, but like that analysis right there can save you thousands and thousands of dollars on your tax return just by telling your contractor who is your vendor that should be certain. Like if this is what you're requesting, okay, I want invoices to be a certain way. If they don't, then it's up to you at that point if you want to continue work with that contractor or not, because they could be costing you $1,000 on your tax returns, because if they just put everything into one lump bucket, then it just goes on your depreciation schedule, where depreciation is great for the building because most likely you're using leverage. Is not as great with repairs and maintenance because that's actual cash out of pocket that you want to expense in year one. And if you're doing a time value of money, like the dollar's worth more now than it will be in the future. So you want to claim as many deductions as you can right there. So those are the two of the main that I see people missing out on a lot, like not fully taking advantage of cost segregation, no matter what size of the property, as well as getting itemized detailed invoices from your contractors.
Yeah. And that's a great point that you brought up with the value of the dollar today is worth more than what it's going to be tomorrow. Right. So getting as much of that depreciation that you can claim now, if you do the cost seg, right, that's a huge advantage when you look at, years down the road, what that dollar is going to be value wise to you. So another reason why, we tell people, like, if you have the cash to buy a property, don't use cash, get a mortgage and leverage that, because that you're paying, 20 years from now, you're paying yesterday's dollars on a property that's worth well more than what you paid for it yesterday. Right. So definitely a great way to look at it. Definitely a great mindset to have. So definitely appreciate that point of view. Now, going more now towards like what you do in your career, I would like to ask you, out of real estate investing, out of being a CPA and helping people and helping them learn these items, what is it that you enjoy the most about what you do?
I'm starting to enjoy the aha moment for a lot of people, because at the end of the day, like what I do and what I recommend isn't rocket science. I'm not a doctor or anything. If I'm just crazy enough to kind of read through the tax code and look at tax case laws, I'm crazy enough to kind of look at those and apply that to people's individual situations. And then once people actually understand and get like, here's the yellow brick road that I'm trying to take you down. And here's what the benefits they can provide. Like that premise of seeing people going from having to owe a whole bunch of money in previous years to actually not owing as much, or possibly even getting a refund, and understanding like, here's what we did. It's like, that's great. Like that's exactly what that's what I'm reaching for, is that. Because when I tell all my clients, like, there's a few things that are going to happen when you work with me. One, we're going to end up being friends, because I'm gonna be digging into your personal life quite a bit. So like, you're going to understand how my mind works, because I'm gonna be asking you a whole bunch of questions, because I need you to understand what I'm trying to do, so that you can benefit from it from that standpoint, and what the tax laws is saying that you can or cannot do. From that standpoint there. So that's the premise of what I enjoy the most about what I do.
Right on. So yeah, of course, somebody coming to you for those kinds of services, they're going to be your friend because you're getting into the personal information. But you know why else they're going to be your friend? You're getting them some money back. So anybody who's helping me get some money back, save me some money, or giving me money, man, you're my friend. But anyway, no, that's fantastic. And you have a great mindset when it comes to wanting to help others, and by what you're doing with educating people. You said that you enjoy those aha moments, and that's a really fantastic just personality that you have. So I just want to say that I really appreciate that as well. Now, this is going more personal into what you're doing. What kind of asset classes do you personally currently invest in?
Currently, my current portfolio is a mixture of, there's a few single families from just when I started, small multifamilies, and some moderate sized multifamilies between Virginia and Georgia. But now connected with groups like RIZE Equity Holdings. So we're also looking for larger properties. So I'm looking to get more into larger apartment building space there, as well as new community development opportunities as well. So working with different housing authorities, land banks, to kind of get an idea of what the city is looking for. And possibly providing, whether it's single family or multifamily, just whatever housing needed with the shortage that there is place going on right now, where we can kind of fit into that space. So jumping into, like I said, different buckets and different groups, but that's my main focus is moderate to large apartment buildings and new community development.
That's great. That's awesome. Not only are you preaching how people can take advantage of real estate, you're doing it yourself, right? And you practice what you preach, and that's important. Now, I want to ask you, so if there's any last tips or tricks that you would recommend that we haven't covered for the average Joe that's looking to start investing in real estate and they're not sure, what to do right now.
I think the main thing is, because what I end up getting a lot from, especially a lot of new clients, is that they're just not sure if their current tax professional is kind of guiding them in the right direction, or is equipped to kind of help them in this new venture, but the mistake people have with CPAs and is thinking that you can just kind of tell them anything and then like they'll figure it out. Because a lot of us, and I've been guilty of it as well. Like I just started specializing in real estate 3 years ago. But before that, I was just taking on clients because it's always just volume, and that drives income and all of that. But then it's like, okay, do I want volume? Do I want to add value to people? So to that point, that's why I kind of made that mental switch. I was like, okay, I can't help people that in spaces that I'm not going to specialize in. So if you're in the healthcare space, then like, okay, unless you're going to buy a building, like I don't know all the tips and tricks. If you're in stocks, like I can just scratch the surface, but I know very minimal. Like I much rather now be a master of this trade of being a tax professional for professionals in real estate. And the error people get is that they kind of stick with what they know, and they stick with their tax professionals who may not know the nuances because they're just a jack of all trades. Nothing wrong with that, but as people are growing in their real estate career and start to like acquire more and more properties, you really have to look at all of your not just your CPA, but all of your professionals, similar to how you look at your doctor. And I like that example because if I have a foot problem, I'm not going to go to a dentist. Both are smart as hell. Both went to medical school and passed, and then they got degrees and all that stuff. But one specializes in feet and one specializes in teeth. And then that's as simple as that. And really, you have to look at your tax professional in that same light of the tax code is just a body itself, and there's different components that each one can specialize in servicing it.
Yeah, I like it. You've got your particular niche that you want to focus on, and you're going to provide the best value with your service to folks that are in that niche. And instead of you switch from that volume mindset to more of the I want to target like a certain market that's going to be more advantageous to them and to you, because it's a little less stress because you're able to focus on something that one, you enjoy, and two, you're quite knowledgeable about. So that's awesome.
Yeah. Plus it turns into like all my clients are now, like I said that they're my friends, but they're also potential partners. And I say that's really a bigger goal that like I have more partners now, whether it's capital or deal flow, credibility, so forth. It's like, okay, I just don't have clients now. I have a basically a bucket full of people that I can reach out to and say, I got this deal I'm working on, you interested? And I'm probably going to get a yes out of somebody out of that bucket one way or another, because I'm building that group along the way.
Yeah, you've got that abundance that we were talking about earlier. Yes. So that's phenomenal. All right, so this has been awesome. I really enjoyed this entire conversation. You're extremely smart when it comes to taxes and the advantages that people can take when they're investing in real estate. So if somebody was interested in learning more about you, where would they be able to find that? Do you have a website, social media that you could share with us?
Yes. I'll give my cell phone, 757-535-8592. Like, I'm kind of on the Gary V route now. I'm gonna put it out there, and then people are more welcome to call or send me a text. Just leave a voicemail if you do call, because I don't answer numbers I don't know. But I typically try to respond within 72 hours to a new text or a voicemail. But I'm on Facebook, I'm on Instagram, I'm on LinkedIn. I do have a link.com virtual business card. Mike, I'm assuming you'll put that in the show notes somewhere.
Yep.
But they'll give them access to like all my email, my number, all my social media, as well as other recordings I've done, podcasts I've been on. Just same thing, just kind of putting information out there for people to kind of take advantage of, and whether they come to me or take it back to a tax pro, that doesn't really bother me. It's just the information is out there, and more people can benefit from it.
Love it, Larry. I love it. I mean, that mindset that you have is refreshing, and I really enjoy the fact that you're out here trying to help people and help educate them. So again, thank you so much for taking some time to chat with us today. I can't wait to get this episode out there. It's going to be awesome.
Appreciate it, Mike.